My name is Brian Kaz, and I'm joined by my friend and business partner, Sean Casey, and we'll get going on the training right here of understanding the basics of stock trading and options, a beginner's guide. Now, first, we have to have a disclaimer here, and that's, of course, that always do your own due diligence. It shouldn't be taken as financial advice, nor are we financial advisors. That's just our opinions and such. And of course, this is just obviously training on like the basics of stocks in here. There's nothing really that can probably be mucked up too much here. As always, do your own due diligence on that right there. And that's always a good idea to do that with anything online at all right there. Starting off, the basics. What is a stock? Represents basically ownership in a company. Shareholders essentially earn or make money via price appreciation of the stock itself or from dividends. Not all stocks will pay a dividend, but even if it does not, the appreciation of the stock itself is how you'd earn money on that right there. So again, pretty basic stuff right there. Now, buying versus selling a stock, obviously, this is no brainer. You want to buy a stock if you expect the price to rise over time, and you want to sell if you want to either lock in profits or if you want to short the stock. So, if you think there's a reason it would go down, especially if you think the fundamentals of the company have changed, or you think your money would be better spent elsewhere, or you need the money, that's the time to sell right there. That's one of the great things about essentially Trade Canary and the newsletters, that you can get basically insights into the businesses. You can see if basically insiders are buying or selling, and you can get an idea of how the companies are doing and what the fundamentals and technicals and all that look like. And you can follow along the advice that we say when we're basically personally buying or selling. Now, besides just basically buying stocks, which is perfectly fine, and I want to take a minute just to reiterate that if you're brand new, buying stocks straight up and selling stocks straight up is the easiest way to start because there's not much to it. There's a little less risk there. So if you only want to do buying and selling stocks, you don't want to get into options, that's perfectly fine. When we do our picks, we'll often say there's certain stocks that we're buying straight up. There's certain ones that we might be doing like a call option on. If you just want to buy a stock, or if you just want to only follow us on the stocks that we say to buy, great, go for it. If when we have a call on a stock, if you want to basically buy it instead, great, that's fine too. Don't feel like you have to do options. I'll get to the pros and cons of options in a bit, but it's definitely something like, especially once you dipped your toes a bit, it's definitely something to look into that might be of interest to you. So what is an option? It's basically contracts to buy or sell stock at a set price by a certain date. And we'll get into that in just a little bit. So it might be like, hey, if you think the stock will go up a lot in the next year, you might want to buy some options on it or some call options on it where you think the stock will maybe go up in that time. And I'll share in a bit what that means in just a bit, because they can be used for leverage and flexibility. So typically when you buy a call, let's say you buy the rights to 100 stocks at a time. So if you were to essentially buy a call, that's basically when you're expecting the price to rise. So you want to buy calls if you're expecting the price to rise over time. They're basically profitable above what we call a strike price before the expiration date. And I'll explain that in just a bit. We'll show off exactly how to read that in just a bit here. So let's say there's a stock that's basically currently at $4 and you think it will go up to $5 or more in the next few months or next year. You might buy a call that says, hey, you pay what's called a premium to basically control 100 stocks, where if the price goes above, let's say $5, if that's your strike price, you're basically owed 100 stocks times whatever amount is above your strike price. So if it goes from, if let's say the strike price is $5 and the stock goes from $4 to $6, you just basically earned $1 per stock, but times 100, because you basically control 100 stocks right there. And oftentimes, if it's like a $4 stock, you might have an option that costs maybe basically 20 cents a stock. So for the rights to 100 stocks, it would basically be $20 out of pocket right there. You could possibly make, in that case, $100 off of, or more if it goes up even more. You can also sell call options where you agree to sell a certain amount of your stocks if they reach a certain price within a certain time frame. So let's say you own 100 shares of, let's say basically Apple, okay, or basically any stock, but let's just say Apple right now. Let's say you own 100 shares of Apple, and you say, hey, I want to sell an option, and let's say the price of Apple, and I don't know what they are right now, but let's just say they're at $200, okay? If you say, hey, I'd be really happy to make 50% on that, I'm going to sell a call option where if the price goes to $300, I'll give away that stock for $300 per stock to this person that I'm selling a call option to. And they might say, hey, I'll pay you, let's say $5 per stock, so $500 for 100 stocks, for the right to buy your $200 stock at $300 if, let's say, in 3 months or 4 months or 6 months or whatever it might be, the price goes to $300 or more. Now, why that's neat is, first, if the price does go real high, let's say it goes from basically $200 to $320, you lose your stocks, but you're selling at $300 per stock, so you're making a 50% profit on top of the premium that they paid you. Whereas if the stock does not go up that high, you get to keep all your stock, but you also get the premium that they paid you on that. We'll talk a bit more about that in just a bit right there. That's definitely more of an advance then. You don't have to worry as much about that right now if that's above your head. And again, if any of this is, whoa, way over your head, no worries. Again, you can stick to just buying and selling normal stocks to start with, and then dip your toes into buying like call options, then later dip your toes more into selling call options and all that right there. Another kind of option is called a put option. You would buy a put if you're expecting the price to drop. So if you're expecting the stock to go down, is profitable below the strike price before the expiration. This means that, hey, if let's say you think the Apple stock is at, let's say it's at basically 200 right now, and you think that the stock is going down, you might say, hey, I'm going to buy a put at 180 bucks. And that means that if the stock goes below 180, you're making pretty good money on that. You still control 100 stocks right there. So if it goes, let's say, to 170, you'd get basically 10 times 100 right there. You'd earn $1,000. You can also sell put options where you agree to buy a certain amount of stock if the stock falls below a certain price within a certain time frame. And towards the end of this call, we'll actually get into a bit more of that strategy on what that means. But that basically means, okay, if you like Apple, and let's say it's at $200, you could say, hey, you can say, hey, I want to sell a put option where I'm agreeing to buy the Apple stock if it goes below a certain price. So you agree to buy it, let's say at 180 bucks, even though it's at 200 now, and you're paid a premium. Now, in the worst case, if the stock does drop more, you have to buy it at, let's say, 180 bucks. But if you like the stock anyway, and you're about to buy it at $200 right now, you're buying it at a discount from what you were about to. And if it doesn't drop, you get paid the premium. And this is a good strategy if there's certain stocks that are stable that you want to accumulate, that you like how they are in the long term, you can buy these at a discount. And again, we'll get back into more of that method or strategy in just a bit right there. So how do you read a call option? This is a recent option that we gave on our newsletter on the Patreon post. One of the picks, which was basically DraftKings, we gave this, for lack of a better word, this code or this option right here. You saw like a period, DKNG 260618C60. And if you're used to doing a lot of options, you're like, oh, thank you, super easy to copy and paste that in and buy the exact same option that we did. Whereas if you're brand new, you might be like, whoa, I don't know what that is. So this is how you break that down. So the first bit is what's called the stock ticker or the symbols. In this case, DKNG is the stock symbol or ticker. In this case, this is for DraftKings. If it was basically Tesla, the stock ticker is, I think, essentially TSLA. If it's like Palantir, it's PLTR, I think, so on and so forth. So the stocks symbol will be the first view right there. After that, the next two numbers, or I should say the first two numbers, is the year that it basically expires. So in this case, 26 means it's basically 2026. So this means there's a whole year, because right now it's basically 2025. So that means there's basically a whole year until it expires right there. And then the next two numbers is the month. So 06 is June. And the next two numbers after that, 18, is the day. So in this case, it says June 18th of 2026 is when that call option expires. And then the C stands for call. So that means you're basically buying a call. If it's a put, it'd be a P. And then the last two numbers, or the last number there, anything that comes after, in this case, C, would be the strike price. And that's the price where if it goes, in this case, above that for a call option, you're in the money. You're making good money right there. If it goes below that, you're not quite in the profit there yet. And I'll get into some more details on that, but that gives you like the basics of it right there. So right here, to read this, we're basically saying, hey, for this right here, we're basically buying a call that expires on June 18th, 2026, so about a year out. We're buying a call with a strike price of $60. And I forgot exactly what we paid for this. Let's say if it was like, let's say $1.50 per stock, that would mean for one call, which is for 100 stocks, you'd be paying 100 or $1.50 times 100, so $150 for one call option to basically control 100 stocks. So if the stock basically goes to, let's say, $70, when this expires, you'd have basically $10 times 100. So you'd be making $1,000 profit, or you'd be making $1,000, then of course minus your cost of 150 in the example I just gave right there. Now, a lot of people ask, do you only make a profit if it goes above the strike price for a call? In a lot of cases, you can make a profit even if it hasn't reached the strike price. And that's because you can basically sell these calls as well. So let's say right now that basically DraftKings, I don't know offhand, but let's say they're at like $35 or so. If next week they go from 35 to $45, it's still below the $60 strike, but because there's a whole year left, the value of that call goes up a lot. So you can turn around and sell it for a profit. Now it might be like, hey, you paid 150 for it, and maybe in a week it basically doubles or triples, even though it hasn't reached the strike price yet. So you can sell it pretty quickly and make, in some cases, essentially 2 or 3 times your money back, even though it's not above the strike price yet. So you can, even if the strike price isn't reached yet, you can still make money on these in the short run, even if it hasn't reached the strike price yet. That's one of the neat things about options, are that you don't have to buy the entire stock to still get the benefit if the value starts to go up right there. Now, there's a few key terms to know here that I've gone over. Again, the strike price, that's the fixed price at which the holder of an option can buy, in the case of a call, or sell, in the case of a put, the underlying asset. The expiration date is the date on which the option contract expires. On this date, the option is no longer valid. Now, a question that sometimes people have is, what if you have a call and the strike price is 60 and the stock price jumps to 70, but you forget to sell the option. That's okay, because when it expires in that case, you're automatically entitled to the 100 stocks at that price. So you would make the extra profit right there. Yeah, so not a big deal there. The premium is the cost paid by the buyer to the seller to acquire the option. It essentially represents the price of the option. So for instance, if let's say a call option is $1.50, that really means $1.50 times 100 stocks. So it'd be $150 to buy one call of that, but you'd be controlling 100 stocks. And the neat part with that is, in the example I just gave, it says, hey, for $150, you could maybe control 100 stocks. And if the stock right now is, let's say, 35 bucks, for the same amount of money of 150 bucks, you could buy what, like 5 stocks compared to controlling 100 stocks. So that's why essentially options can be a neat thing, because it leverages your money in that way. A couple other terms that you don't have to really understand these, but it's terms that we sometimes say. So I just want to get these out there. There's sometimes we use terms like volume and open interest. So volume is the number of option contracts traded during a specific period. So it might be that, hey, on the market right now, there's a huge number of people buying or selling contracts, or essentially trading contracts this week or next month. So that's, if the volume jumps up a lot, that might be an indication that, hey, people think it's basically going up or down. Like they think something's about to happen. That's why Trade Canary has stuff where we can look at and see, okay, has the volume of these trades increased a lot? What exactly is going on? The other term is the open interest. That's the total number of outstanding option contracts that haven't been settled or closed yet. So they haven't expired or been sold off or anything like that. So they're still on the market right there. You'll also sometimes hear us use terms like essentially in or out of the money. In the money, or basically ITM, means that the option has intrinsic value. So like the stock price is above the call strike price. So if the strike price is 60 and the stock's at 70, you're in the money. Out of the money, or basically OTM, means that the option has no intrinsic value. For example, the stock is below the strike price. So let's say if the stock is at 50 bucks, but the strike is 60, you're out of the money in that case. However, you can still sometimes make a profit even if it hasn't hit the strike price yet. Let's say you bought the option when it was at 35 bucks, it's now at 50, and you have a strike of 60. That option's typically worth quite a bit more, maybe basically 2 or 3 times than what you paid for it, as long as there's a fair amount of time left in that. And we'll get into that in just a bit right there. So differences between the two with basically stocks. The pros are you have basically an ownership stake in the company, unlimited upside potential. You can get a dividend income, or at least it's possible to get a dividend income if they pay one. There's no expiration date, so you don't have to worry about any of that. Simpler to understand. It's super easy to buy and sell stocks. And again, if that's what you want to start with, that's perfectly fine. There's nothing that says you have to do options. In fact, between all of us at essentially Trade Canary, some do mostly just stocks with some basically options on the side. Some are like probably like an equal mix of both, but like everyone is also buying stocks. It's not like there's someone just doing options and nothing else. Me personally, I buy a lot of stocks. I also do some options, but a huge amount of what I have is in stocks, as it's simpler to understand. It's also good for long-term wealth building, because you don't have to worry, okay, if there's a stock that you feel really good about in the long run, it's very hard to basically predict what will happen in a day or two, but a lot easier to oftentimes predict what will happen in like the long run. So in a case like that, this is great for long-term wealth building. Now, the cons are that it requires the full stock price and capital. So if you want to buy 100 stocks or basically control 100 stocks, in this case, you have to buy whatever the stock price is times 100. So it can be a lot of money, especially if it's an expensive stock. There's lower leverage because you're not really leveraging anything at that point. There's slower profit realization because again, if the stock basically jumps up, let's say a fourth, which let's face it, that's really good. If you have a stock that, next week it basically jumps up by a quarter. In fact, we just had one pick that I think we mentioned maybe 4 months back that I think today alone actually jumped up 20%. If you just own the stock straight up, hey, you have basically a 20% gain for the day on that stock. That's really good. If you had an option, that could be worth a heck of a lot more, like sometimes a couple to several multiples of what essentially bought the option for. And of course, with any stocks, there's always risks of the market and volatility, although not as much as like an option. There's also company specific risks as well in stocks as there are in options. But when you look at options, the pros is that you have a high amount of leverage with a smaller amount of capital because you don't have to buy 100 stocks straight up to control 100 stocks. You're basically paying a tiny fraction of that to control 100 stocks over a certain amount of time. There's also limited risk with that because worst case, when you're buying like a call, worst case, you only lose the premium paid. So if you want, let's say, if you want to control 100 stocks of, let's say, DraftKings, and let's say it's a $35 stock, if you want to buy the stock straight up and control 100 shares, that would be $3.5 grand. But if you want to control 100 shares on the option side, if it's, let's say, $1.50 per one times 100 for $150, you can control the same amount of stocks. So that's what's neat with that right there. And worst case, if let's say if the company goes bankrupt, that the next day the place gets nuked and the business is gone, which for legit businesses is very rare that they go from a big business to zero in a very short time. But if that does happen, if you had a call option, you only lose the premium. Worst comes to worst right there. There's also multiple strategies that you can do. You can also profit from any market direction with options because again, you can buy calls or puts, whether you think it will go up or down. You can hedge existing positions, and it can also be a great way to generate income. There's multiple strategies with that. It's also a great way to make a quick profit. It can have a high quick profit potential, much higher than owning the stocks themselves. Now, of course, the cons are you're basically dealing with expiration dates. So there's time decay in that. There's tougher strategies, a higher learning curve. You can lose, worst case, 100% of the premium. You don't have the ownership of the company itself or anything like that. Now, just to clarify, when I say, hey, worst comes to worst, you can lose 100% of the premium. Just like in stocks, same with basically options, you can also have something in place where you can basically dictate what kind of loss you want before you sell. So if you want to say, hey, if it goes down basically 10 or 20%, I want to get out. So you can hedge your losses right there. So in most cases, if it starts to go down or get bad, you can basically get out before it goes to zero. But yeah, so that's the pros and cons right there. In a nutshell, to dumb this down even more so, basically, stocks are typically lower risk, require more capital, are not time sensitive, but are more moderate profit. While options are higher risk, need less capital, are time sensitive, and have a higher profit potential. And again, you don't have to do options. You can just stick to stocks if that's what you want, but I think it's a great thing to be aware of both. And eventually, once you become a little more experienced, to definitely dip your toes in them as well. Because again, you don't have to risk a lot of money in a lot of these cases, which is always a great thing. So when to use stocks versus options. You can use stocks for long-term investing while using calls for short-term upside. On the long-term side, hey, if you think, hey, in the long run, you really this business, you're not sure what it will do this month, but in the long run, you think it will be awesome. That's a great one to buy and own that stock if you think in the long run it's going up. Whereas if you think, hey, this stock just got hit massively by a factor that shouldn't really affect it, but for whatever reason, the price went down a lot and you think it will come back strong in the short term in the next month or so, that's great for a call because you can make many multiples of your premium back in a case like that right there. You can also use puts for hedging or bearish bets if you think a stock will go down. So that's when to use each one. Now, some bonus strategy tips. And again, in just a bit, Sean will actually go through live buying and selling these. So you can see him actually do it inside of essentially Charles Schwab account. So don't worry about that. We'll actually show you live so you can follow along right there. But I want to give a handful of bonus essentially tips right here. You want to ideally, unless you're a pro, okay, you want to ideally avoid same day expiration unless you're very experienced when you're buying options. More time equals less risk. The premium can be a bit more, but that's oftentimes worth it unless the cost is really high, because the more time you have, that means you have a lot more time for the stock to go up or down. So we sometimes buy calls that are a year out or more. Now, they might cost a bit more than something that's only out a month or two, but you have a lot more time to make that move right there. Whereas if you're buying an expiration in a day or two, man, it is really hard to tell, what can happen in a day or two with any stock, because like almost anything can go wrong. Even like right now, imagine if you have a stock that's absolutely primed and everything looks like, hey, this is going to explode. And then 1 hour later, essentially Trump gets on the news and says, hey, we're raising tariffs even more. And we're basically doing all these crazy things. Right then, the entire market could just tank and your great stock could go down for that day or two big time. Even if it's basically better in the week, for that one day, it could go down. Likewise, the opposite could happen. Someone like Trump, could say, hey, we're getting rid of tariffs, or hey, we're having like a 90-day pause on this, and the whole market could jump up a bit. Where again, it's very hard to predict a lot of the short-term stuff. So that's why more time is typically a lot less risk. And you want to always calculate your max loss, especially when dealing with options. Hey, if you're comfortable possibly being out $100, great. You can buy a $100 option or set your loss at a certain percent or dollar amount where you won't be out more than a certain amount right there. That's always a great idea. You do not want to risk money that you're not okay losing. Don't say, hey, I'm very confident in this, I'm going to bet $10,000 and that's all you have. And because you never know what happens right there. So always calculate your max loss and what you can deal with right there. You can also sell puts on stocks that you want to accumulate in the long term, because that can be a great way to get a discount if they drop, but also collect free money if not. It's also great for stocks that fluctuate up and down a lot in the short term. An example of this is with one of our picks, INTC, or basically Intel. It fluctuates a lot between $18 and $22. So it's been that way for a long time. So it's a great way where you can buy and sell puts based upon where it is on that scale. If it's closer to, let's say, the 22 side, maybe you can sell some puts there. If it's closer to the 18 side, you can buy some calls, knowing that it will go like up and down that way right there. Another thing that we get asked a lot is typically we never like to buy calls on an up day and vice versa. Reason is they're usually more expensive. So if there's a down day, that's typically cheaper when you're buying a call than if there's an up day. And typically in the market in any given week, there's probably almost always going to be some up and down days. So, you want to kind of time when you buy it. So if there's a day where, let's say the stock is at a loss and we say, hey, this is a good time to possibly buy the stock here, but you take your sweet time and a day or two later, the stock is up, let's say 5%. That doesn't mean you should jump in and buy it right then. Maybe wait a day or so and see if it pulls back some right there. But it's also why you want to stay on top of things like the newsletter and the picks and stuff like that, because with this essentially options, they're a lot more time sensitive on that stuff, especially in the short term. Now, if we have a long-term option, not a huge deal. And if you're just buying a stock in the long run and your plan is to hold it for a long run, again, not as time sensitive right there. You can also limit the risks of bigger losses on both stocks and options by putting a stop loss in place. We'll show you an example of this in a bit, but that's just saying, hey, if let's say you buy a stock or like an option, and let's say it's like $100 and you're saying, hey, the maximum loss I want is $10. So if it drops to less than basically 90, it can automatically sell right then. So if the stock or the option falls below a certain level, you can sell it off before it dips more. For instance, if you have a 5% stop loss, that would mean that your worst case scenario is losing 5% of your specific investment. Now, there are pros and cons of that, especially if you go too small on your stop loss, because you might have in a given day, if ever you've watched the market in like a given day, you'll see that the price can drastically change a lot. You might have something that starts the day down 5% and ends the day up 10 or vice versa. So if you have a stop loss that's too small, let's say the stock starts the day down 5% and you have a stop loss at 5, you might have it immediately sell everything. But if it ends the day up 5 or 10%, you lose all that because you immediately jumped ship. Typically, try not to go too small on that because stuff can fluctuate a fair amount throughout the day right there. Now, selling puts or calls can sometimes make good returns in a short amount of time, as long as you like the stock. So this is, and again, we'll get a bit more into the strategy in just a bit. Sean can talk on it, or I can once he shows you more of the live stuff, where again, if you really like a stock, but you want to basically get it at a discount, you can offer to sell a put on that, where if it dips below a certain price, you not only collect the premium, but you're entitled to 100 stocks at whatever your lower strike price was. So it'd be a discount compared to what it is right now on the current day. And that works well if you really like the stock and think, hey, it has good long-term potential right there. One more thing before we get into live examples here, and I won't dive too deep into this right here, but I just want to say, hey, if you're basically making, let's say you buy 100 different stocks, even if you have an awesome winning record, not all of them will always be winners, especially in the short run. But a loser doesn't necessarily have to be the end of the world, because there's something called tax loss harvesting. And that's where, now, rules can vary depending upon the country that you're in. This is the rule in the US. I know in a lot of the other countries there's a similar rule, but basically you can sell stocks at a loss to take a tax deduction against your long-term or short-term capital gains. So that means, hey, if you have a stock that has gone down, you can sell it and basically take a loss that you can use as a deduction against your other long-term or short-term capital gains. In the US, at least, as long as you don't buy the stock back within 30 days, you can essentially take it, or essentially count it, as a deduction. Some tax loss harvesting strategies involve selling the stock basically at a loss, getting the deduction, and then after a month or so, buying it back, as long as there's a valid reason to do. You're not meant to intentionally exploit this. For instance, you're not meant to sell a stock, take the loss, and 30 days later buy the exact same stock with the sole intention of basically doing the tax loss harvesting. You're meant to have a reason to do, but the reason could be something as easy as, hey, the fundamentals of the business changed, you like it a lot more now, or you like the earnings report now, or you didn't like it prior. So it can be a great way where if there's a stock that's temporarily gone down a fair amount, you can take a loss on it and have it be a deduction, and then later buy back into it at a cheaper price while still taking your deduction. So definitely just something to mention right there. Feel free to research that on your own and check your own country if you're outside the States, but a lot of them have a rule like that right there. Quick recap And next steps before we go into the live part where we'll show you how to do this stuff live. Stocks equals ownership. Basically, options are strategic contracts, so you can leverage a lot more. Trade Canary helps you identify trades. You can watch our training videos and our monthly live training webinars to help with all that. And you can even follow along on our exact trades if you want via our Patreon weekly newsletter, where each week we oftentimes tell you specific stocks that we're basically buying or doing options on. So you can follow step by step right there. You can also use Trade Canary to get alerts on your own stocks, find new opportunities, and so forth. And of course, feel free to ask questions either on the newsletter comments, which we loved any feedback and stuff there, or via support@tradecanary.com. So with that now, we have one more strategy that we'll basically get to once Sean shows off some stuff right here, but we're going to actually pause it right here and switch over to Sean's screen, and he's going to show you some live examples of buying and selling stocks, doing call options and puts, so you can see him actually doing all that. He'll be actually doing that inside of a Schwab account, or essentially a Charles Schwab account of his that he has for essentially testing this. Now, keep in mind, you might have a different account. They're usually very similar in how you buy and sell stocks or how you buy and sell options. If you're on a different brokerage account and you're like, hey, it looks a little different, you can just go to Google or ChatGPT or YouTube and type in, how can I buy a call option, or how can I buy or sell a stock in whatever brokerage account you have. But this one should basically be fairly similar to what most of the other ones are right there, but it'll give you a pretty good idea. So without further ado, I'll hand it off to you, Sean.
All right, thanks, Brian. Hey, everybody. First of all, I'm just making sure you can see my screen, because I can see my screen, but that doesn't help if you can't, but just put a yes. Okay, great. Thanks, Kim. All right, just want to make sure you're there. Okay, so I'm in my Charles Schwab account. Not to be funny, obviously you have to log in. And once you do, and Brian said, all the trading accounts pretty much work the same, whether it's Schwab, Robinhood, Interactive Brokers, whatever. And we have training on a lot of the different platforms. But the most important thing to know is this: if you get stuck, you're going to buy stock, sell stock, do anything, all of your brokers have support people who know every single thing possible about how this stuff works. And they're available anytime the market is open, and most of the time when it's not, in any kind of reasonable hour, to help you if you get stuck trying to make a trade. Okay, because that's their jobs, that's what they're getting paid for, and they're available faster than our support. Not that you can't ask our support, but these folks are sitting there waiting to help you. Okay, so once I'm in my account, in this case in Charles Schwab, I can click on trade, and it gives me a bunch of choices of different things that I could do. But I'm just going to click on stocks and ETFs, and it's going to open this screen, same screen we were in, but I want you to know how I got there. And then in this drop-down menu, you can choose which account you want. You can see I'm in my Roth account, and in that account right now, $67,000, so you know how much you can buy at this current time that you have for buying power. And from there, especially buying and selling stock, really simple. We can put in a symbol, and you can see it has ones that we had in here before, but you can start typing in any symbol. And let's just use Intel. So we can go in INTC, and you'll see that it should, come on, it should have popped the drop-down menu for me. Hang on, there you go. So you can see Intel here, and you can even click on and be like, oh, I have the right company. And then once this comes up, it's going to show you that we have Intel Corp, that the market's closed. So it always tells you if it's open or closed. When it's closed, the numbers don't change. When it is open, these numbers will be clicking up and down. But you can see the last trade and what the pricing is. We can see the bid and the ask. The bid is what somebody will pay for the security. The ask is what somebody wants for it. We can also see, hang on, I got to move the go to webinar widget. So I can see, you can see in the day range, it was as low as $20.30, the high of 20.93, the 52-week range, and then what it closed at on the previous trading day. Okay, so that gives us all this information right at a glance. We can see exactly what's going on. Now it's also going to tell you if you own stock. You could see I own 400 shares of stock. So it knows that I own that in this account. It also shows that I have 190 option contracts that I own in various configurations on Intel. So it'll even tell you what you already have. And then we decide what we want to do. In this case, we're going to buy. And not to be funny, it's really simple. You just select buy. Don't worry about the other options because we're going to keep this simple. We do a really complex training on this that goes through all the different permutations of things you can do. But in this case, we're going to buy and we're going to pick how many shares, and let's just say 100 shares. And if you notice over here on the right, this automatically updates. See, 2053, assuming I'm going to pay $20.53 a share. But even as fast as I change this, it changes over here and it tells you the total amount you're spending. So you can see that. And maybe you just want to be like, oh, what kind of 66 shares or whatever. But I'm going to put in 100 because it makes my math easy. And then there's an order type. When we go to buy, we have some choices of how to buy. Okay. Now, forget all these stop orders and everything else because they're more complex. And again, we have training on how to do those, but you don't need to worry about them. But when you go to buy a stock or an option, you have two basic ways you can do that. One is to place a market order. Now, market order means that you're going to get whatever they get for you in the market. So in this case, if somebody's bidding $20.51 and somebody's asking $20.53, if you're buying, they're probably going to get this. But you're going to get whatever it is when the order hits the trading system, and it might be $20.62 at that moment, right? So you can't pick your price at market. Generally, you don't want to buy or sell in the market unless for some reason you've got to do it instantly. Usually want to set a limit order. Now, limit order, you notice it gives me a choice of pricing right here. That's super important because now I get to pick the price, okay? So I'm saying right now, like they automatically show the ask price. You can see this matches, right? But you don't have to pay that. Now, normally, in fact, you can get somewhere in between the bid and the ask, like 2052, and you can either plus or minus these, or you can just type in whatever number you want. But let's say that I don't even want to do that, that I want this to, I only want to buy Intel if it goes to $20.25 or 24 cents since I bumped to 4, right? So I could just say, hey, if it isn't that price, I'm not buying it. I want that price or better. And in that case, that means that they're only going to execute this order and buy it if it's that price or lower. And I could set an even lower number, especially if I'm going to let this order sit out there and say, hey, if it goes down to 1950, I'll buy it. That's it, right? So limit lets us control the price, and we really want to control the price. We don't want to get a surprise on what number we want to buy it at. And then there's the timing. This is probably going to seem a little confusing, but it's just not that hard. The two basic choices are that you're only going to have this option, this order to buy open for today, or you're going to have it open for an extended period of time, which is generally known as good until you cancel it, GTC, good till canceled. And as long as you're setting the price and you want to buy at that price, it's up to you how long you want to keep that order open. Because again, we're going to buy at a limit price, so we're going to keep this open. Now, with the limit price, we get a little bit more options. The markets now have what are called extended hours. So extended hours really start, the market regular hours are 9:30 to 4 p.m. Eastern time on business days the market's open, right? But they have extended hours in the morning that start at 7, go to 9:30. At night, they go from 4 o'clock to 8 o'clock, right? Which many stocks actually trade, including Intel, as you can see. So we can have it for the day. We can have it for the day in extended hours. And why not if you're buying at the price you want or later selling at the price you want, right? We can be good till canceled. We could be good till canceled in the extended hours. Now, you can also just trade in the extended hours, but normally you're not going to do that. Fill or kill means you put in your price, it either goes instantly at your price or it doesn't go at all. Okay, you'll probably never place an order like that. I don't know how many hundreds of trades I've made. I've never done that. Okay, but generally you're really just going to be the day in extended hours or good till cancel in extended hours. Good till canceled, it puts in a date. You can limit it. They default to a 6-month time frame basically. But I could say, oh, listen, I only want this to go until July 12th. Okay, so I'm gonna only make this until July 12th, and after July 12th, this order won't be open anymore. Whatever you want to do there. So that's in as simple as a nutshell as possible. You can see there's really not a lot of choices that you have to make, unless you're making up your own trade. But if you're following one of the trades that we're making, where we're saying, for example, buy Intel at, let's say, 1950, and you just pick how many shares, right? This is all you've got to do is just go in and place the order. When you're ready to place the order, you can save this to use in the future. That's probably more confusing than it's worth. But really what you're going to do then is review the order, and it's going to give you, hang on a second, any second it's going to pop. Come on. Oh, you know what? Sorry. When I was playing around, it didn't like this INT that I put in there when I was showing you the drop-down menu. Give me 1 second. So, like I said, we're going to buy 100 shares. Come on, click in there. Well, we decide we're going to buy at 1950. We're going to buy it good till canceled. And now we're going to click review order. And now it's going to show me this is exactly what I'm doing. The summary is right here. I'm going to buy 100 Intel at 1950, good till canceled with extended hours until December 12th. I can then click and the order gets placed. If I want to change it, I can change it or I can cancel it. Once your order is placed, if it hasn't filled, like obviously I'm putting in to buy this at 1950, the stock's at $20.51, right? It's not going to fill right away. If I'm like, I don't want to do that, I could just actually go cancel the order before it's filled even. That's why it's good until cancel, because I can cancel it. Okay. Now, so real quick, I'm going to show you how to sell this in a second, but everybody with me so far? Okay. Somebody just posted Schwab support is available 24/7, so you're good. All right. Everybody okay so far? Yes, yes. Okay, great. Like I said, for those of you that haven't done this before, look, you learn to send an email, right? You learn to post on Facebook. You learn to install an app on your phone. All this stuff you learn to do is harder than actually doing something like this. Okay, good. So I'm going to go back and I'm going to click on trade again. And I'm going to click on stock. Right. And I'm going to put in INTC, and it's going to show me Intel. But this time we're going to go sell Intel, okay? Because right now, you can see I own 400 shares, so I can click sell. And then let's say I want to sell 100 shares of my stock, and I just put in 100. And again, I want to sell with the limit because I want to control my price. I don't want to get a surprise on what the price is. And let's say I sell that when it gets to $25. And I just put in here, look, I don't care if it's in extended hours or regular hours, I'm just going to extend it out. And when it gets to 25, sometime between now and December 12th, it's going to sell, right? Now, you notice, without me having to explain it, how fast you can actually do this, right? Same exact concept, it's just you're selling instead of buying. And if you, once again, you click review your order, and it will show you the order here that we're selling, 100 shares, $25, good till canceled, okay? And the cost basis is just however you have set up your account. And first in, first out is just the first stock you bought is the first stock from a tax standpoint that you sell. And you can ask your accountant how you want to do that if you're not sure. Okay, and then I either place order, change, or canceled. All right, so buying and selling stock, not that hard, easier than you probably thought. So let's look at doing this with an option. Option really isn't much harder. There's just a couple things you have to decide. But in the case of trades that we're showing you, we're giving you the information on how to do that. So let's put in the one that Brian used as an example so we can be consistent. DraftKings, I type it in, you can see it comes in here, right? And once again, it's showing us all the information about DraftKings, the current price, and everything else. Shows, that I already have 75 DraftKings option contracts in this account. And I'm going to select that option. And again, an action, I'm going to be buying to open. Buying to open means that I don't have an existing option that I'm working with. So I'm buying to open an option position. Brian mentioned that and that every option contract controls 100 shares. And because it controls 100 shares, you can see that forget all this stuff on the right. I'm going to get to that in a minute. That it's going to show there's a bid, a mid-range, and an ask. Usually you can get the pricing at the mid-range, both the buy and sell. So let's just move that to 92. Now at this point, with one contract, I'm really controlling 100 shares. So it's 100 times the $92. This is maybe the only thing that's slightly confusing. So to buy one option contract, I'm going to $92 for this particular contract. It's not the one I'm going to buy, but just as an example. So hopefully everybody sees that, right? And if I buy 2 of these or 10, if I say, hey, I want to have 10 contracts, I'm paying $920. So it's quoted basically the per share cost, but what you're really paying is the per contract cost in the actual buying and selling of an option. Okay, this number is smaller than what this really is for your leverage position. So we're buying to open. I'm going to just buy one contract. The stock is DraftKings. You can see the symbol. Now, this date here is the expiration date. This is when the option expires. And as Brian explained, the sooner it expires, the more volatile it's going to be because it's going to move up and down with the pricing faster than if you have more time. And if you have more time, you have a lot of time for the trade to work in your favor. And the example he showed you, you can see you can go all the way out to 2027. But the example that he was talking about, June 18th, 2026. So we're going to make that our expiration date. All right. And you notice now it costs more to buy an option where we've got a year until it goes, right, than it was at the one that expires this Friday. Okay. There's a big difference. Okay. By the way, this jumped because they don't always have, they have 50% increments here, and this was 37.50 before, but out there they don't have 37. So that's why, for those of you that are trying to figure out why did it change to a weird number, I didn't see it before. Let's go to June 18th, and we're going to go way out of the money. We're going to go look at a $60 option price, okay, out here for the strike price. The strike price is that we're looking for the stock to rise. We're going out here at $60. It gets us a much lower premium per share. Brian was also explaining how, look, yes, if it goes to 100, hey, we're going to be $40 in the money, right? This is going to be awesome. Now, I'm not telling you it's going to 100. Don't get all carried away and be like, Sean said it's going to 100. I didn't say that. Okay, but if it does, that's awesome. But really, in the meantime, what we're looking really more for that is the stock currently at 37, whatever, is going to go up. And let's say it goes to 45. Well, when it goes to 45, 45 is a lot closer to 60. The premium to buy or sell this option is going to go up. And when the premium goes up, we can sell and make a profit. And that's one of the things that you'll see in some of our things that we're doing in Trade Canary and our announcements that Eric's been doing on a regular basis. Now, when we look at this option price, there's a big spread between bid and ask. And then you can see the midpoint where this is most likely to trade. Now, the super important thing is that when you look at option prices, especially in the market's not open, they tend to get really big bid and ask spreads because once the market opens, they tighten up a lot, but they just overnight, in a lot of cases, get really big spreads. Now, tomorrow morning, if this was the same, hey, you could automatically get it for paying $2.60. And if you were selling, you could get $1.67, but almost all of these will trade really close to this midpoint and still get you filled. You really almost never want to pay the actual ask price, especially with a spread this big, right? So we could go in and say, hey, listen, we're willing to pay $2.13, or we'd like a little dip. Let's let it back up a little bit. We'll say we buy it for $2.05. Again, we're going to buy it with a limit order, okay? And as long as I've got a year for this to play out, I really want to buy it. So again, I can just go in and buy it and make this good till canceled. If you notice, there's no extended hours because it's an option. They don't trade in extended hours, which is good because there's only so much time you want to look at anything in your computer and worry about. But I'm just going to make this good till canceled, and I'm going to set my price and look for it to back up, to go down a little bit, give me a little bit better price at 205. And that's all I have to do. So with the directions that we give you before you're figuring out your own option trade, if you're new, really just following what we've said. If you notice, as Brian broke down that example, I'm just buying to open a contract for DraftKings for June 18th, 2026. That's expiration at the $60 strike price. It's a call. This is my pricing options, but this is where I'm going to put in what I'm willing to pay. And then I'm setting up the order. So while this has more moving parts than a share of stock, really you can see not as complicated as you would think that would be. And again, I can click that I'm going to review the order, and it's going to tell me all about the order. This is what I'm buying. I'm buying a one contract, okay, and I could buy 10, I could buy 50, but I have owned 75 contracts on this, okay? And this is what it would cost, $205. There's an industry fee that goes in, and then 65 cents commission. So it cost me a total of whatever, $205.66 to buy this if I clicked place. Does anybody have any questions on this particular, on the option part before I go any further and show you how to sell the option, which is going to be pretty simple, as you'll see in a second. Because if you can buy it, selling it's easy. Okay, just give a second, see if anybody got any question on that. But I think you can see this is not as hard as you thought it was going to be, because you just literally, it's like filling in the blanks in the order form, right? So we're going to go sell, and selling is almost, exactly what we just did, except we're going to put in, we're going to sell. So in this case, we're going to say that we want to say, all right, and in this case, we're going to sell to close. You buy to open, you sell to close. And if you happen to get the wrong thing, they would not let you sell something you don't own. But we'll go in here and we'll, again, change this to be our, whoops, I got to get down further. June 18th and the $60 strike price, okay? And they default to the 167 price because that's the bid. We're not going to sell for that, but we want to make profit on our money. We paid, what did I say? We're going to pay 205. So let's say, hey, we're willing to sell it for $4.10 and double our money. And we make that good till canceled. And then it's same thing. We just go in, we review our order. Obviously, I own this option because it let me go sell it. I figured that those were some of the contracts I had. So anyway, not as hard as you thought it was going to be. And hopefully now you're ready to go out and conquer the world, because we built Trade Canary to help you guys learn to invest, take control of your investments, have great opportunities. One of the biggest things, because this really is an investor call, and I know because I recognize some of the names on here that some of you guys are much more advanced than beginners, but number one, everyone has started at the beginning when they bought their very first share of stock or very first option. And everybody had to learn the first time. Millions of people have bought and sold stocks on their own. You can learn how to do this as well. Just learn as you go along, take baby steps. You'll be astounded how fast you're going to pick this up. Remember, everything you've learned new took a little bit of time, but think about the things you can do now that you couldn't do originally. Whether it's working on a phone, working on a computer, whatever.
Yeah, and one thing I'd say too, like Sean has a Charles Schwab account. I believe I also have one, but not my main one. I know I have one on Charles Schwab. I have one on Robinhood. I have a few through basically JP Morgan or Chase. On some, it's, again, they're all relatively similar. Some might be slightly easier on like the user friendly side, or slightly harder. All typically are about the same. But if you're on like an oddball one and you're like, man, like this looks nothing like what Sean's screen is here, and it's like some oddball brokerage account, no worries at all, because 99% of the time you can just Google or YouTube or even just go to Chat GPT and say, hey, how do I trade a stock inside of whatever account you have? And it will literally walk you through, or on YouTube, it will literally show you exactly how to do it within your specific account. There's hundreds of different brokerage accounts out there. There's probably only like 15 or 20 main ones, but there's a lot of smaller ones out there. So if you're on one that you're not sure, just watch like a walkthrough on how to do a trade with a quick YouTube search, and you should be perfectly fine right there. Because again, it's not all that hard, especially if you just want to buy a stock straight up at the market price. Literally clicking a couple buttons, you can have it done right there. So Sean, I wasn't sure if there's anything you wanted to add before we switch back.
No, I think we've got it good. If people have questions, just type them in. Brian's going to show you something really cool.
Hopefully
We'll be all
see
set.
the PowerPoint screen.
And you're there.
All right. Now that you've seen how to buy and sell stocks as well as options, there's one more special method or strategy that's semi-advanced, not tough once you know the basics. So we just thought, hey, let's share like one of these relatively easy methods, but still advanced ones right here now that you have the basic knowledge right here. It lets you make money in the short term while buying stocks for the long term at a discount. And that's essentially selling puts for a premium or lower cost stock acquisition. In a specific situation where you want to acquire shares in a company at a discount, or you believe that stock will not fall further and you want to earn income, you can sell put options. Warren Buffett has actually used this strategy often to make millions of dollars for his company. For example, we'll use Lumen, which has the ticker LUMN, which Sean showed off, which not only is a company we like, but it has a chart that we like as well, at least right now in the current time. They recently agreed to sell their consumer fiber business, which we believe will further boost the stock price. We'd like to own the stock at a discount, but we're happy if we just get to sell the puts and keep the premium as a profit. So in this case, AT&T agreed to buy the Lumen's consumer fiber business for $5.75 billion. So Lumen stock, as of the time of the slide right here, was $4.05. You can sell puts that expire on July 18th, which isn't that far off, like a few weeks or so, at a $4 strike price for 30 cents. So that means that, hey, if the stock drops below $4, you're basically obligated to buy 100 stocks at $4 a pop. So in that case, you'd be out $400, but you'd own 100 stocks of that. But if you already like it now and it's at 405, you're basically buying it at a discount. You're buying it at 5 cents less than what it is today. So if you like it today and you think in the long run it will do well, you don't really care if it goes down to 390. You don't care if you think it will do well in the long run if it takes a little teeny tiny dip in the short run right there. But you can sell that for 30 cents for every $4. So that means for 100 shares, you get $30 that you receive just so someone else has the option to have you buy it from them. So basically after the fees, you'd be just a bit shy of $30 there. The broker holds $400 for each contract to make sure you have the funds to buy the stock at the expiration. So that means that if the stock falls below the $4 strike price, in that case, you would be sold 100 shares at $4. So you'd be out the $400, but you'd have 100 shares right there. If it stays above the strike price, you just get to keep the $30 and don't have to buy any shares or anything like that. So on July 18th, one of two things will happen. If Lumen is $4 or higher, so the puts expire worthless, and you keep approximately $30 net for a 7.33% profit in 5 weeks on $400. Now, of course, if you had 10 times the contracts and you want to say, hey, I'll buy $4,000 worth of this, you'd be up $300 instead of 30, but you get the idea here. Or the second thing, if Lumen is less than $4, so you buy the stock at $4, you already earned some of that extra money per share. You earned approximately 29 cents per share from the selling the puts. So your net cost is only $3.71 per share. So if the stock is less than $4 but higher than $3.71, you have a profit. For example, if the stock is $3.90, you buy for $3.71 and could sell for $3.90 and make 19 cents per share plus the 30 cents per share you already received. Or on top of that, again, if you like the stock anyway in the long term, you don't really care even if you keep that stock, because again, you're buying it at a discount compared to what the price is right now today. So why is that neat, and when can this be used? This can be used if you have high confidence in a company that you really, and you're about to buy stocks anyway in it up front. You can buy them at a discount this way right there, where you can either basically just collect the premium, and in this case make 7.33% profit in a matter of 5 weeks, which is a very big return for not really having to risk a ton right there. If you look at like the S&P, which has an average of around, I think, 8 to 10% for a year, you can get this in 5 weeks right here. But if, let's say, hey, the stock does go down a bit, you can get the stock at a discount then. So if you're about to buy it at $4.05 and hey, it goes down a bit and you get to buy it at $3.71, who cares? You're basically buying at a discount. You now own 100 of those stocks for less than what you would have previously bought it for right there. And if it's in the middle right there, you can still make a profit because again, you got paid the premium on top of that right there. Occasionally we can or will recommend this on a newsletter post. We don't do it like too often on the post. It's a bit more of an advanced strategy, but it's one that we wanted to mention because it can be a great way to make a little bit of dough on the short term in a matter of weeks without a ton of risk right there. Sean, did you want to show off something? I see it went back to
I'm going to show you guys something. So first of all, as Brian was just telling you about, we like this trade, and you can see, seriously, we like it so much that you're in live in my account. You can see I have 100 contracts doing this. But I did make a mistake. I didn't switch this from call to put, and I want to correct this. Okay, so in this case, like I said, we're going to sell to open, all right? And for those of you that want to see this, okay, we're doing this for July 18th, 2025. It's the $4 strike price, and this should have been a put, all right, because I'm going to sell a put to open. And if, you know, right now I'd get, if I switch to the mid price, hang on, 28 cents, right? And if you did this like we talked about the 100 contracts, you could see you'd get $2,800 for doing this. But you need more money in your account to post a security, like Brian said, for this, but whatever your number is. But basically, this is the right setup. This is how we would do this. We're selling to open, however many contracts you wanted to do, pick a price now. And I can tell you that when I was doing this trade, my average price that I got on the contracts was $29, 29 cents per contract. And I sold 50 at 30 and 50 at 28. You know, for the 30 cents, I put in a 30-cent price and the market came to me. You could, in this case, put in 30 cents in this example. Now, if you're watching this video other than when we're live, do not run out and do this trade, because this trade was an example that we're doing specific to the time frame when we recorded this video. So don't get all carried away, or you're watching this in August or September or whenever you're watching the video, be like, I want to go do that trade. This one doesn't exist, but there's more that are live in the membership then, I'm sure. Okay, so this is how we would sell to open and sell to put. And Brian, I'm gonna switch it back to you now, but I wanted to fix that because I didn't want to leave anybody confused. And Brian, you're now the presenter again.
Yeah, so thanks for that, Sean. So that's just a quick example there of how this strategy or method can be a good one. Having said that, we want to basically end on two things right here. First, a summary of some stuff right here. If you're not already receiving the newsletter, make sure that you sign up. All members can sign up for, or I should say, all members of Trade Canary can sign up for free at this link right here for the newsletter on Patreon, which is just basically patreon.com/Trade Canary. So make sure to sign up there. If you have any questions or any issues, you can always write support@tradecanary.com. They'll always get back to you within 1 day or less, usually within an hour or two during the business hours. So they're very good with that. So make sure to use that. And of course, if you're asking where the software itself is, you should have a login for that, but that itself is just at essentially tradecanary.com, and you'll see a login link right there. I just want to also point out that there's a lot of training basically posted under the training tab, and a lot of times people actually miss the sub tabs. In the top right of the software, you'll see a training tab. When you click that, you'll see some of the basic trainings, but then you'll also see tabs along the essentially top side where you can click any of the subcategories and it will actually pull up more training on that stuff right there as well. We'll have this call actually posted probably at some point tomorrow. So we will have the recording of this up tomorrow. And as far as the training next week on the software itself, which we'll dive into not only like more on how to use the software, but some specific strategies with the software, how to get alerts for your own stuff, how to get alerts for insider buying, how to find new opportunities and new stocks on your own as well, like even outside of us on the newsletter. We'll have that training next week, and we'll post a link up to the registration this week's newsletter, which we'll have on Wednesday probably. So we'll post out that with a link for you to sign up for that, so you can get to the updated training and see a lot of the new features and stuff that we have. Or of course, if you just want to follow us along on our own picks on the newsletter, you can feel free to do so right there. Having said that, if you guys have any last minute questions or anything like that, I know we've been answering a lot of them here, but if you have any last minute ones, feel free to ask it right here. And if you're still like, if you're confused on anything or not sure on anything, by all means, let us know. That's why we're here. So don't be shy. Don't feel like, oh, this went right over my head. I don't know what this is or that is. Feel free to ask. That's what we're here for. And again, if you're like, whoa, I don't know if I want to jump straight into options, you don't have to. You can just basically trade, buy and sell normal stocks to start with, and until you get your feet a bit wet there. Or if you just want to stay at buying and selling normal stocks, that's fine too. We actually use both methods ourselves, so that's perfectly fine. But any questions, feel free to type those in. Just gonna see if anything popped up. I know Sean has been answering a handful of them. All right, so the next training, if you're talking about the one I just mentioned, we'll do it sometime next week, and I will mention it on the Wednesday weekly newsletter. We have to figure out the exact day and time, but I'm guessing we'll maybe have it on Wednesday next week, but we'll see. If you're asking about our monthly trainings, we have monthly trainings usually on the first Wednesday of every month, and we post about a week ahead of time on our newsletter when we have a call the next week. So you'll get alerted to that and can sign up, but you only get alerted if you're on the Patreon newsletter. So make sure you go to patreon.com/Trade Canary to sign up, because again, it's free if you're already a member. So make sure to do that. All right, lots of thanks. Thank you guys. All right, okay, this person
Brian,
asked
I'm going to jump back in again. One thing I'm watching people ask a couple questions about training on specific things. I know we have a lot of new members, but you got to go in through the training tab. There's a lot of training on the specific parts, like in Trade Canary, on how to do research, how to set alerts, how to look up unusual option activity, how to look up insider buying and selling. All of that training is in the member area. So you don't have to wait for us to have a live training on something specific. And if you can't find training on something, you're like, I know it has to be here somewhere, but I can't find it, just ask support, because they know where all the videos are. And you can just ask them and they can tell you where the video is. So you don't have to rip your hair out if you're like, hey, I want to know where the unusual options activity video is, or I want to know where on insider buying is. They can tell you where it is and you can jump right on that. Okay.
Cool. Yep. So it looks like.
All right. Hey, I want to thank everybody for coming and participating, and most of all for being members. And we look forward to helping you guys have very successful investment portfolios. Even if you're starting small, everybody started small. Warren Buffett didn't start out as a billionaire, but he kept making investments, getting results, compounding his returns the same way that we're looking to help you guys do it, so we can all increase our nest egg together.
All right. Thanks much, guys. And again, if you have any questions that essentially pop up later, that you're like, man, I wish I asked this, but I forgot, just write support at tradecanary.com and we'll make sure to answer there. And yeah, look out for an update on Wednesday on our training for next week, where we'll go through the software itself as a special bonus training on how to start with the software itself and showing off a lot of the new features we have, because there's a lot of features that a lot of people are missing because they're brand new, and we've talked about them in the past, but a lot of people are missing them, and there's some that can make a lot of money. Definitely watch that one. I think it'll be a pretty exciting one. So yeah, with that, have a great rest of the week, guys, and look forward to seeing you next week. Take care.